Hello, in this presentation we will be entering an adjusting entry related to an invoice that has been entered after the month in which the work was done into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. What we have here is a normal invoice, and the invoice is part of the normal activity within the accounting department. So why would we be looking at an invoice in the adjusting process? In this case, it's because this invoice, the work was actually done prior to the cutoff date. In other words, we're looking at the month end of February, and this invoice had work completed, meaning we delivered the guitar in February, although the invoice was not generated until March. So we can tell that if we were in a situation where we actually have physical goods, we can look at the shipping documents and say, when did we actually ship the guitar, or when did the guitar leave our warehouse or our store? That's the point in time that we have completed the work under the revenue recognition principle. There's various reasons why it might be the case that the invoice didn't get processed until later, and that's the point in time that an accounting system like QuickBooks will process the revenue at the point in time the invoice is generated. Under a revenue recognition principle, we need to find those invoices and we need to put them into the current month, the month in which the revenue was actually earned and the related cost of goods sold was actually incurred. In this case, that month is going to be in February, although the invoice was dated and issued in March. We need to pull that income back in. So if we look at an invoice, we've seen a couple invoices here and consider the journal entry related to it. In this case, we're selling inventory. So we're going to have the sales price, which is going to be the $500, is going to be the sales price, and that's going to increase accounts receivable. As it is an invoice, it'll increase the AR, this is on account, and the credit would then go to sales or some kind of income account. And then of course we have the payable, which will be for the sales tax payable of the $25 on the $500 sales price. And we have the other items that are not on the invoice, remember. That's related to the cost or the inventory going down. Our merchandise is going to go down by some number other than the 500, something lower than that, what we purchased it for. And the related cost of goods sold will be recorded all through this invoice process. When recording something like this into QuickBooks, we typically would use a journal entry process, but it is possible to record this with the use of registers as well into QuickBooks and try to avoid needing to know debits and credits. With this particular transaction, because of its complexity, debits and credits, if we know them, are much easier to use than the registers. But if we don't know debits and credits, it is possible to enter this information using just registers as well. We will be using debits and credits as we enter this into Excel at this point. Here we are in Excel. We're going to enter this adjusting entry. Like all adjusting entries, it will be as of the end of the date, as of the end of the time period, which is 2/28. And we're going to enter the invoice now, and we're really just recording the journal entry for a normal invoice process, and we're going to record it before the cutoff date. So we're just going to enter the journal entry related to the invoice as of now, even though the journal entry was made or the invoice was generated after the cutoff date, in order to recognize the revenue at this point in time. In order to do that, we'll just do a normal invoice type of journal entry. So first we're going to say, is cash affected? And we're going to go, no, it's not affected. What did we get instead? We got an IOU, we got accounts receivable. Accounts receivable has a debit balance. We need to make it go up, so we're going to do the same thing to it, which in this case is another debit. So we'll copy the accounts receivable in K4, right-clicking and copy. Put that on top in B12, right-click and paste, 1, 2, 3. The amount then is going to be the amount that we're going to receive. We can calculate this a few different ways. The sticker price is $500. There's sales tax of 25% or 5% times 0.05, and that will give us $25. And if we add that to the original sales price plus 500, then we're going to get 525. We can also calculate that as 500 times 100% plus 5%, or 105%, or 1.05. That also giving us 525. Let's do that same calculation here. We are in C12. We're going to say equals and type in 500 times 125% or 1.05, and that will give us 125. We're then going to credit something, and when we make the sale, it's going to be revenue. So we have assets, liabilities, equity, and then the revenue. These are our revenue accounts. We earn the revenue when we did the work. We're talking about merchandising revenue because we're selling goods, in this case, a guitar. And so we're going to credit the revenue. We have a credit balance in revenue. Revenue always goes up in the credit direction. Therefore, we will make it go up by doing the same thing to it, which is another credit. So we're in K21, going to right click in K21 and copy. We're going to paste that in B13, right clicking in B13 and pasting 1, 2, 3. We're then going to adjust the formatting just a bit, go into the Home tab, the Alignment group, and increasing the indentation. We're then going to credit it, but not for 525 because we're not actually earning the sales revenue of 525. Only 500 of it is ours, the sales price. So we're going to put a credit negative of 500. We then have, of course, the debits not equaling the credits were different by $25, which can be calculated as 500 times 0.25, or what happened there? 500 times 0.05, which is the 25, and that's going to be the sales tax, the 5% of the 500. I'm going to do that with our plug formula, the negative sum formula. So I'm in D14, negative SUM, double clicking the sum function and highlighting the 525 to the 500 gives us that difference, that $25. We just need to know the account now. That's for the sales tax. That's for what we're still going to owe that in the future. That will be going to sales tax payable. So here we see the sales tax payable. It has a credit balance. We are increasing it because we owe the sales tax payable on the sale to the government agency that required it. So we're going to copy K16, right click and copy. We're going to paste that here in B14 by right clicking and pasting it. 1, 2, 3, values only. Going to increase the indentation. Going to go to the Home tab. We're going to the Alignment group and increasing the indentation. So that's going to be the first of 2 journal entries. The second's going to deal with inventory. But let's post this first, see what happens to our worksheet. So we're going to post this now, not to the general ledger, but to our worksheet in the adjusting column. So here's the accounts receivable. That's the second account on our worksheet. We're going to post that right here in cell M4. So we are in M4. We're going to select equals and point to this 525, bringing the balance of receivables up from $10,449 by 525 to $10,974. Then we have the merchandise sales. Here's the merchandise sales. Scrolling down, that's going to be it's in order, of course. Assets, liabilities, equity, income, merchandise sales, credit balance. We are in cell M21. We're in cell M21, selecting equals and pointing to this $500, bringing the balance up from 2,000 credit by a credit of 500 to 2,500. Then we have the credit balance in the sales tax payable. There's the sales tax payable. Here it is on our trial balance. We're going to be here in cell M16. We are in M16, selecting equals and pointing to that $25, bringing the balance up from $100 by 25 to 125. So there's going to be our transaction. Notice what happens to net income here. It increased by this $500. So we had an original net income. That is income, not a loss. That's net income, not a loss, meaning revenue minus expenses, revenue credits winning over the expenses, debits by $6,847. And then it changed by these 2 amounts, the 500 and the 25 we had before. So the net increase is 475 to 7,322. We're now going to record the other side. So we're looking for the other side now. And that's going to be related to the inventory going down and the related cost of that inventory, the cost of the goods sold. So here's the inventory account, and it's a debit balance account. We sold stuff, and therefore we got less inventory. So the inventory needs to be going down. It has a debit balance in it. We're going to do the opposite to it, which will be a credit. So we're going to copy K5, right-clicking and copy. We're going to skip a cell because we want to put it in a new row, and then we're going to skip another one because we want to put it on the bottom of the new journal entry. And now we're in B17. So I'm in B17, right-clicking and pasting 1, 2, 3. The amount then, we don't really know it yet because it wasn't on the invoice. So if we go and take a look, I'm going to look at the last tab and look at our ledger for the inventory. So I'm just going to click on the trial balance tab, and I'm in columns CE through CP. That's going to be where the inventory is. We sold an ELP, so we sold an ELP and they cost $400. So the cost is $400. So we're going to go back to our adjusting entry with that knowledge, and we are going to decrease the inventory by $400. And we're going to debit something also for that same $400. And where will that debit go? It's going to go to the cost of goods sold and expense. We consumed the guitar in a way in order to help us generate revenue by giving it away. And here it is, cost of goods sold. It's an expense account, even though it doesn't have the name expense in it. It goes up with a debit like all expense accounts do, and therefore we will increase it with another debit. So we're going to copy the cost of goods sold. We're going to put that on top in B16, right click and paste 1, 2, 3. I'm then going to indent this bottom number just to indent that. So we're on inventory asset, home tab, align and increase the indentation. So here's the journal entry we have now journalized into the adjusting general journal, and we're going to post it not to the general ledger but to our worksheet. Go into the adjusting column to see the change really quickly from the unadjusted trial balance to the adjusted trial balance. So we're going to post the cost of goods sold. That will be down here. There's the cost of goods sold. It's in M24. So within M24, the cell M24, we're going to select equals, point to that 400, bringing the balance from 1,600 up by 400 to 2,000. If we scroll down, then we will be out of balance by the 2,000, and we'll see that that brought down net income. So our net income went up by the 500, down by the 100, and then this other entry brought it down as well. So the net change so far is 75 increase. We started off with a net income, that's not a loss, it's income, 6,847, up by 75 to 6,922. Now we're going to record the other side to inventory asset. Here is the inventory asset in M5. So we're in cell M5, selecting equals, pointing to that $400, bringing the balance from 1,714 down by 400 to 1,313. If we scroll back down, we are back in balance, so everything looks good, and that is that adjusting entry for the inventory. Remember now that you might be thinking that this could cause us problems if we had already recorded this invoice in March, and it will be correct as of now, as of our cutoff date, as of the end of February, but as of March, we're going to have it in there 2 times, meaning we will have recorded the receivable 2 times, and we will have recorded the revenue both now, and it'll be recorded again in March, and same with the cost of goods sold. And one way to fix that is to have reversing entries and reverse this entry for the first day of the next month, because then we can just issue the original invoice and everything will be okay. So this is an instance where the reversing entries can be useful.